Hi everyone, and thanks for tuning in. My name's David Tagg and I'm Head of Investments and Research at Commonwealth Private. And with me today is our Senior Investment Strategist, Nick Ryder. G'day, Nick.
G'day, David.
Over the next 10 minutes or so, we're going to talk through some of the questions that we've been receiving from you, our clients, in recent weeks. And I'm pleased to say that there's been a lot going on at Commonwealth Private. Over recent months, we've increased the size of our investments and research team and invested in some additional research tools. This has allowed us to accelerate the expansion of our investment offering, and the team and I look forward to sharing that with you in coming weeks. But before we launch into today's presentation, a reminder that the remarks we're making today about economies, markets, products, and securities are of a general nature only and not tailored to any individual circumstances. I'd like to start by letting you know how we've performed over the last year or so. Our balanced portfolio has produced a return of 16% for the financial year to June, ahead of the benchmark, the peer group average, and comfortably ahead of the CPI plus benchmark. Those outcomes are consistent across longer timeframes as well. And on the slide here, you can see on the left the growth of the portfolio over time, and on the right, the risk-adjusted returns. So since inception, delivering higher returns on an annualised basis for a level of risk in line or lower than the benchmark and the competitor averages. Similarly, our core equity portfolio has delivered strong performance over an extended period. Higher returns on an annualised basis, and again for a level of risk in line or lower than the benchmark and our competitors. I'd now like to introduce Nick, our Senior Investment Strategist, who joined the Investments and Research team in May this year. Nick has more than 25 years of investments and markets experience and is a great addition to the team. So welcome, Nick, and perhaps we can start by addressing the first few questions, which are centred around COVID. In particular, when's the disruption going to end? And why are we locking down with a similar or smaller number of cases than other countries like the US?
Yeah, thanks, David. I mean, it's a very good question at the moment, and certainly something that investors and clients alike are concerned about. And I think that it's important just to go back to kind of this time last year and talk about, why lockdowns were used. And really, the reason lockdowns were used was because back then we didn't have a vaccine, and really what the health authorities were trying to do is break the nexus or the connection between infections, COVID infections, and hospitalisations. Really, they were concerned that there'd be such a large number of COVID cases that needed to be hospitalised that the health system would collapse. And so that's really the basis for lockdowns. Fast forward to 12 months and, it's amazing that we have these vaccines. Typically vaccines take 5 to 10 years to develop. And really no one thought we'd have vaccines, but we do have a number of vaccines now, which are being progressively rolled out around the world. And you can see the chart there on the left. The countries like the UK and Israel and the United States, which had significant amounts of COVID last year, have really done quite well in getting large chunks of their population vaccinated. And they've been able to open up. So, for example, Israel, succeeded in vaccinating about 60% of its population mid-year, and it opened up in June. The US, the UK had its Freedom Day in the middle of June. It's currently got about 80% of its adult population vaccinated. And there's also a large chunk of the population that have natural immunity because they've had COVID previously. So those countries are close to what's called herd immunity, and they've been able to open up. And yes, we've seen COVID cases rise dramatically in those countries, but fortunately, the number of hospitalisations and deaths in the UK and Israel so far have been relatively modest. So for Australia, what does that mean? Well, I guess, if we look at the National Cabinet Plan, which has, reduced number of lockdowns once we get to 70% of the adult population having been fully vaccinated, and very infrequent lockdowns once we get to 80%. Based on that sort of timeline, we can expect that we will be opening up in sort of November. So we would expect that lockdowns would become less frequent in 2022. That's not to say that they won't be used, but they'll certainly won't be widespread. They'll be hopefully shorter, and that they'll be a less of a public policy or health tool in 2022.
Thanks, Nick. And so perhaps thinking about the impact on business confidence and also consumer sentiment, given what we're seeing, what are your thoughts there?
Well, if the past year is anything to go by, we did see consumer confidence and business confidence rise quite sharply, as we got through the worst of the first wave of lockdown in Australia. And both, you can see from the chart there on the left, business conditions and business confidence were actually, recovered very, very sharply. Now that's turned around with the latest, lockdowns in Sydney and Melbourne and Canberra. But we would expect that once, we get back to sort of semi-normal conditions, once, we reach that 80% threshold of vaccinations, hopefully later this year, that business confidence should be able to recover. The same with consumer confidence. Consumer confidence recovered quite sharply last year, as things got back to normal. And we'd expect the same thing to happen in Australia next year. We also look at what's happening with business confidence and consumer confidence in other markets. It does tend to kind of move with lockdowns and with COVID cases. So our view is that the vaccination program continues and that we get a general recovery into 2022, and that'll allow both business confidence and consumer confidence to recover. That said, I think it's going to be a bit of a bumpy ride. It's not going to be smooth sailing, and if there are localised short lockdowns next year, then we could see both business confidence and consumer confidence take a bit of a tumble. The longer term, we would expect it to recover. The other thing is there are some sectors like tourism and hospitality and arts and entertainment where, potentially it's going to take a much longer time for those sectors to get back to where they were, and therefore we'd expect those sectors and also smaller businesses, potentially the business confidence in those sectors will be, perhaps longer to get back to where they were.
Okay, thanks. And there's been a lot of comments about inflation, and certainly there are some cyclical effects there, but also some structural trends as well. And some of those structural trends, you would argue, could be disinflationary, in fact. But how's COVID impacting measures of inflation and interest rates? And can the RBA really wait till 2024 to raise the cash rate?
Yeah, so we've been saying in our market outlook for the last few months that we think, the inflation pressures are transitory. And particularly if you look at, headline inflation in the United States and in Australia, it's been driven by a lot of one-off factors, because we are comparing the year ago levels, and things like free childcare last year and falling oil prices really pushed inflation down. And when we roll forward 12 months, those base effects mean that, inflation is obviously a lot higher this time this year compared to the same period last year. So a lot of these forces are temporary. In the United States, for example, a big part of their inflation lift has been driven by airfares and hotel accommodation and used cars. And we think that they're mainly temporary forces that will dissipate. Fortunately, the Reserve Bank, which, in Australia looks at trim the mean inflation, which strips out some of the volatile items. And in the US, they look at, other measures of core inflation. those measures haven't necessarily gone up to the same extent that headline inflation has. So, yeah, we think that there are some inflation pressures that will probably be lasting as you know, we get through this COVID period. You know, for example, the workforces, you know, are potentially smaller than they would be due to immigration and border controls. But generally, we think the inflation pressures will not be as you know, as sustained as people might think. In terms of interest rates, our current thinking is that you know, once we get through the current lockdowns and things hopefully return to normal, the strong labour market that we saw up until a few months ago in Australia should be sufficient for wages growth to lift and inflation to lift towards the RBA's target range of 2 to 3%. That's the trimmed mean inflation. And therefore, the RBA will be in a position probably in late 2023, mid to late 2023 to lift interest rates. In terms of you know, the US central bank, you know, that they're also taking a view that inflation pressures are transitory, you know, and they're more focused on the labour market returning to full employment, and that will also take some time. And we think that's probably late 2022, mid 2023. So interest rates are going to be very low for a while, and yeah, hopefully that answers your question, David.
Thanks, Nick. And one of those really popular questions we get from clients a lot, what does that mean for term deposit rates?
Well, obviously, term deposit rates are influenced by a few things. One is the shape of the yield curve, and we can see the yield curve in Australia has flattened a little bit. So there's been a bit of a lift in sort of 3-year, 4-year rates, whereas longer-term rates have fallen. So medium-term term deposits of 3 to 5 years will probably go up a little bit as we get closer to the RBA's first rate hike in mid-2023. But the other thing driving term deposit rates is just the bank's demand for funding. And we know that they've drawn down $188 billion under the Reserve Bank's term funding facility. And that's money that they can borrow for 3 years at just 0.1% per annum. So they're currently awash with funds, and you can see that in the chart on the right, which shows how much extra cash they're sitting on at the moment. Substantial amounts. So certainly for the time being, even though we've got strong loan growth in Australia as the property market does quite well, they don't really need that funding from term deposits. So they won't be out there offering very attractive rates for the next couple of years. So with all those forces, we'll probably get term deposit rates rising in a couple of years' time, I would have thought.
Thanks, Nick. Look, in summing up, economic activity continues to recover, and although we discussed in our quarterly outlook at the start of 2021 that the recovery would be strong, we also said at that time that we thought the recovery would be a little bumpy, and that obviously has been the case. Overall, though, we remain positive on equity markets, preferring them over bonds. Although experience tells us we're overdue for a pullback, and a 5 to 10% fall in equity markets would not surprise us and would present an opportunity for us to use some cash to add to equity positions. And as we heard today, the Delta variant has proved challenging and bears close watching. We think inflation pressures will ease, but there is some risk there, which is why we're underweight bonds. And again, if bond yields were to push materially higher, that would present us with an opportunity to consider adding some cash back to fixed interest. The team continue to actively manage the portfolios with a laser focus on both risk and return. Thank you for watching today, and thank you for your support of Commonwealth Private.